In this video, I will reveal the 8 assets that look super smart, but they aren't really. It's the ones you'll want out of your portfolio before you turn 60. Because what separates rich retirees from everyone else isn't just how much money they accumulate, it's what they refuse to buy. And unfortunately, the odds are that you own at least one of these things right now. So let's get right into it. Let's start with the first one, timeshares. On the surface, they look smart. A guaranteed vacation every year, they're locked in. And that's the pitch, right? You're not buying a week somewhere, you're buying a lifetime of family memories. But here's what the wealthy families I work with understand. A timeshare isn't an asset, it's a liability. It's a liability with a nice brochure. See, once you sign, you're stuck. There's hidden fees, special assessments, maintenance costs that climb every single year, whether you go or not. And if you ever want out, the resale market is basically zero. You can't sell it. I've actually watched people list them online on Craigslist or something for $1. $1 just to get somebody to take over the maintenance fees. And the smart families, they do the opposite. See, they keep their money liquid. They rent where they want, when they want, and they're never trapped in a contract that turns into a forced expense for the rest of their lives. By the way, my name is Chris McClure. I've been a financial advisor for 31 years, and I put these videos together about once a week. It's honest information for high net worth families who have worked too hard to leave money on the table. The next one is, unfortunately, it's going to sting for some of you, and it's vacation homes. You see, the dream is beautiful. It's a place at the beach, or maybe it's up in the mountains. It's somewhere where the grandkids can come every summer. But for most people, that dream turns into a financial burden. And let me tell you a story about Todd and Amy. Todd was 63, and he spent his whole career as an orthopedic surgeon. Between his practice buyout and their savings, they were sitting on about $2.8 million. So they'd done really well. They were financially secure. But they bought a place in Florida years earlier. It was $1 million home and it was right on the water. It was beautiful. And when they sat down with me, Amy did the math out loud for the first time. She actually calculated it in her head and kind of wrote it down. Property taxes, insurance. And unfortunately in Florida, insurance is crazy. It's brutal down there. She had HOAs, landscaping. They had a HVAC or an air conditioner that died the first month they weren't there. So they were spending somewhere around $40,000 a year to keep a house that they maybe used 3 weeks a year. And so Todd really thought about that. That house was worth $1 million just sitting still. That same million in a simple, diversified portfolio throws off something like $50,000, $60,000 a year. And it throws it off year after year. The house wasn't just costing them $40,000 that they spent, it was costing them the $50,000 or $60,000 it could have been making. And that's a lot of dough to tie up for 3 weeks on a beach. You see, Amy looked at Todd and said, "We've been paying for this property because it's a postcard." And these are smart people. They just never looked at it this way. And you think about it, what could you do with an extra $50,000 or $60,000 per year? If you had an extra $50,000, they could visit their grandkids, pay for their grandkids' college education, take a couple of once-in-a-lifetime trips. And the families I see, they treat it differently. The wealthy folks, they'd rather rent something nicer than they'd ever buy, right? They want to stay flexible. And they want to let that capital that's tied up in the house actually work for them. They don't want it sitting in a house for 11 months a year. They want it creating income. The next one is rental properties. Now, I want to be careful here because I have a lot of clients, I'm sure a lot of people that watch this own rental real estate and it has made people very wealthy. But in retirement, the wrong rental property creates more headaches than income. People buy a rental thinking it's steady money coming in. They think it's steady money coming in. What they don't factor in is the vacancies, the repairs, the 2 a.m. phone call about a broken water heater or a toilet. It stops being an investment and it starts being a second job. And you didn't get to retirement. You didn't save all this money to get another job. The families who do this well only buy when the numbers actually look good. And then they hand off the management so it runs like a business and not a burden. See, where people get hurt is these emotional attachments. They love the idea of owning property. So they hold one that's bleeding cash every single month and they call it an investment. In retirement, cash flow is the key. If an asset is eating cash instead of producing it, it's really working against you. The next one is high yield bonds. This one tempts people because on paper, it looks like free income. Higher interest payments, more money coming in, but there's a reason they have another name. Their other name is junk bonds. They pay more because the companies behind them are far more likely to default. And the worst part is those companies tend to default at the worst possible time. When the economy's weak And that income is exactly what you're leaning on. So that safe looking stream of cash suddenly dries up and there's no easy way to replace it, unfortunately. I'm not completely against them, but chasing yield and risky corporate debt and then forgetting about it is really a mistake. The smarter approach is to let each piece of the portfolio do its actual job. Let stocks handle growth. Let high quality short-term bonds or intermediate-term bonds handle safety and liquidity. Don't ask your bonds to act like stocks. That's not really what they're there for. And real quickly, if you're watching this and you're already wondering how your picture stacks up, there's a link below. I'd be happy to set up a call to chat with you about your situation. And number 5 is gold. And I know there's plenty of you that own it. And the fact is you're not crazy to own gold. And it has a real place. But what I see is a lot of folks buy gold because of an ad. They saw it on TV, maybe at 11 o'clock. Maybe it was between the reverse mortgage and the attorney that advertises for accidents. And look, I'm not above late night TV. I watch it myself, but I wouldn't build a retirement on anything I bought at that hour. And the families who get into trouble are the ones who treat it like a retirement plan instead of just a small slice of one. And the problem with gold as a core holding is it doesn't pay you anything. There's no dividend, there's no interest, there's no rent. It just sits there and you hope it's worth more later. Meanwhile, you're paying to store it. You have to insure it. And you're just praying that someday you're going to be able to sell it at a good price exactly when you happen to need the cash. I have a client who had a lot of gold. He moved to Florida from California, but he couldn't ship it because it was too heavy. So he had to sell it and he sold it at the exact wrong time. Think about it this way. You put $500,000 into gold and 10 years later, you've got a pile of metal worth hopefully more than $500,000 and that's it. That same $500,000, if you had invested it for income, it could have paid you $20,000, maybe $25,000 a year that whole decade. And you'd still have the $500,000. Gold just sat there the whole time, earning you nothing while that same money could have been working for you. Most of the folks I work with hold a modest position as insurance against the unexpected. What they don't do is build their retirement income around it. Next is crypto. It's same idea, just turned up louder. I have a lot of people that ask me about crypto all the time. And I've had plenty of successful people sit across from me who got into crypto early and they did well. So I'm not here to tell you it's all nonsense. But there's a difference between a small speculative bet and an asset you're counting on to fund 30 years of retirement. You see, crypto can swing 30, 40, 50% in a matter of weeks. That's fine when you're 40 and you're still earning. It's a very different thing when you're 70 and you're drawing income. The families who stay wealthy treat it like what it is. It's a small, high-risk position that they could lose entirely without changing their lifestyle. The moment it becomes a meaningful chunk of how you're going to eat in retirement, that math stops being exciting and it stops being super dangerous. So if you're holding a big position heading into 60, that's the time to maybe to downsize it. And you don't want to do it after a bad year forces your hand. Then there's non-traded real estate trusts or REITs. Now, we're getting into the products that sound sophisticated, which is exactly why they're dangerous. A non-traded REIT gets pitched as real estate income without the hassle of being a landlord. That sounds great. I don't have to be a landlord, but I get the income. But here's what's buried in the fine print. You can't easily sell it. It doesn't trade on an open market. So getting your money back can mean waiting or accepting whatever price they decide to offer you. The fees are heavy and they're hard to see. And the distributions you're being paid, sometimes they're partly just your own money handed back to you dressed up as income. When something is that complicated and that hard to exit that you can't even sell it, the complexity itself becomes a warning sign. And most wealthy families would rather own something simple, transparent, and liquid. Something that they can actually explain and actually sell. If one of these is already in your portfolio, the move now is to map out how you actually exit while you've got time, instead of discovering you're stuck the day you need the money. And the 8th one, the last one, it's the one that costs sophisticated people the most. And it's these non-traded private investments. And this is a big one. It almost never looks like a mistake going in. It looks like a privilege. You're a successful person, so you get to invest in it. Let me tell you about Reggie and Mary. Reggie was 64. He was a retired chemical engineer. He sold his stake in the firm he had helped build, and he and Mary were sitting on about $3.2 million. So they had done really well. They were successful. And Reggie was proud of one thing in particular. It was a private deal that his last advisor put him in. And he put in almost $500,000. He called it the smartest investment in his whole portfolio. It was exclusive. It was hard to get into. It was the kind of investment that's supposed to mean you've arrived. When Reggie and I sat down and actually went through it, here's what we found. He couldn't get his money out, not for years. It was locked. The fees were actually layered in places he'd never been shown. And nobody could tell him what the thing was actually worth on any given day because there really wasn't a market for it. It wasn't tracked for a value. Reggie told me I thought I was being let into something, like I was being let into something that was super successful. It turns out I was actually being locked into something. But he wasn't tricked. Nobody pulled a con on him. It was sold as exactly the kind of thing a successful person should own. And you see, that's the trap with all 8 of these. The assets that cost retirees the most aren't the obvious junk. They look super smart, but they really aren't. The wealthy families who stay wealthy, they keep it simple. They keep it liquid. They want to have their assets liquid. They want to have transparency so they know what they actually own. They want to be able to sell something on a Tuesday and explain to their kids why they sold it over dinner. So if any of these are sitting in your portfolio right now, you're not alone. And it doesn't mean you did anything wrong. It just means it's worth a fresh set of eyes. So if you'd like to chat about it, there's actually a link below and you can click on that link and set up a time for us to talk. I'd be happy to take a look at your entire financial picture. Hopefully this video is helpful. I really do enjoy making these and I'll see you on the next one.